Spain's real estate market is experiencing a renaissance that most international investors are completely missing. While everyone is obsessing over Miami condos or Dubai skyscrapers, something extraordinary is happening across the Spanish landscape. Welcome to Psycho Investor, and today I am taking you on a deep dive into what might be Europe's most misunderstood and undervalued real estate market. I'm not here to give you vague theories or recycled opinions. I've spent months analyzing market data and uncovering the fundamental shifts that are creating once-in-a-decade opportunities for savvy investors. By the end of this video, you'll understand exactly why Spain's property market is positioned for explosive growth, which regions offers the best potential, and how even small investors can tap into these opportunities without buying a single property directly. So let's get into it. Spain's real estate market has had a tumultuous history. Many international investors still associate it with the devastating crash of 2008, when property values plummeted by more than 30% nationwide. This collective memory has created a persistent skepticism that keeps many investors on the sidelines. But that skepticism is now creating one of the most asymmetric investment opportunities I've seen in years. In this comprehensive analysis, we are going to examine the economic renaissance driving Spain's property market, regional hotspots with the highest growth potential, the supply and demand imbalance creating pricing pressure, demographic shifts transforming housing needs, how regulatory changes are reshaping the landscape, and finally, a strategy for capitalizing on this boom without the headaches of direct property ownership. Before we dive in, a quick reminder. If my Eastern European accent bothers you, just turn on the subtitles and mute the video. The information is too valuable to miss. Now let's start looking at what's actually happening in Spain's economy, because this is the foundation everything else is built upon. To understand Spain's real estate opportunity, we need to first appreciate the economic transformation underway. In 2024, Spain's GDP grew by 3.1%, significantly outperforming the Eurozone average of just 1.2%. This isn't a one-off event. Spain has been consistently outpacing its European neighbors in economic growth for several years now. What's driving this growth? Several key factors. First, tourism has come roaring back. Spain welcomed 94 million tourists in 2024, generating 120 billion in revenue. Projections showed that reaching 100 million visitors in 2025, with revenue exceeding 140 billion. This tourism explosion isn't just filling hotels, it's creating massive demand for short-term rentals as second homes. Second, Spain is experiencing a job revolution. Unemployment has fallen to 11.2%, with 800,000 new jobs created in services and construction. While 11.2% might sound high by American or German standards, it represents a dramatic improvement from the 26% unemployment seen during the crisis years. Third, Spain is becoming a tech and digital nomad hub. The government issued 30,000 digital nomad visas in 2024 alone. Cities like Barcelona, Madrid, and Valencia are seeing tech companies lease hundreds of thousands of square meters of office space, bringing high-earning professionals who need housing. Fourth, mortgage rates are becoming more favorable. The European Central Bank's rate cuts reduced average mortgage rates from 3.64% to 3.0%. This trend is expecting to continue, enhancing affordability and driving demand. But here's what makes this economic revival particularly interesting for real estate investors. Spain's population grew by 1.1% in 2024, fueled by immigration that added 700,000 new residents. These aren't just any immigrants, they include high net worth individuals from the UK, Germany, and Scandinavia who are driving luxury market demand. All of these factors are creating tremendous pressure on Spain's housing market. Real estate investment surged by 20% in 2024 to 16 billion. Transaction volumes reached 642,000 sales, in the third highest figure in Spain's history, and 10% year-on-year increase. The result? House prices have risen sharply, with the national average increasing by 8.1% in 2024, accelerating from 4% in 2023. New-build properties outpaced resales, recording a 10.7% price surge compared to 8.6% for second-hand homes. But these national averages mask the tremendous regional variations that create specific investment opportunities. Let's explore where the real action is happening. Spain isn't one real estate market. It's dozens of micro markets with dramatically different dynamics. Understanding these regional variations is crucial for identifying the best opportunities. Let's start with the urban centers, which have seen some of the strongest growth. Madrid. The capital has experienced price hikes of 10 to 30% in prime areas. Office vacancies fell to 8.4%, with price rents hitting 38 euros per square meter per month. In the prestigious Salamanca district, residential prices have surpassed 7,000 euros per square meter. Madrid's inclusion in the 2025 America's Cup route is expected to boost tourism and investment further. Barcelona. Tech firms leased 120,000 square meters of office space in 2024, pushing rents in the innovative 22nd district to 25 euros per meter per month. Despite Catalonia's rent control laws, luxury properties exempt from these restrictions continue to see strong price appreciation. Valencia. This is perhaps the most interesting urban story. With much more affordable prices to 2,100 euros per square meter versus Madrid's 4,500 per square meter and the 20% increase in tech startups, Valencia is attracting international buyers looking for value with growth potential. Now let's look at the coastal markets, which tell an entirely different story. Costa del Sol. Prices rose 12% in 2024. With Marbella's luxury villas exceeding 10,000 per square meter. The combination of year-round pleasant weather, international schools, and extensive amenities makes this region particularly attractive to Northern European buyers. Balearic Islands. Limited supply drove a 14% price hike on islands like Mallorca and Ibiza. Remarkably, only 0.7% of Ibiza's housing stock is available for sale, creating extreme scarcity that drives prices higher. Luxury properties here can achieve rental yields of 7.3%, which is significantly higher than most European markets. Canary Islands. Tourist arrivals increased 18% year-over-year, lifting Tenerife's rental yields to 6.8%. The island's special tax status makes them attractive for certain investors, while year-round tourism ensures consistent rental demand. But there are also emerging hotspots that sophisticated investors are watching closely. Murcia. Prices grew 9% in 2024, driven by British retirees and solar farm investments. The combination of affordable prices and strong growth makes this an interesting value play. Andalusia's interior. Cities like Jaén and Cordoba offer yields of 8 to 9% for rural tourism properties. As remote work becomes more common, these historically overlooked areas are seeing renewed interest. And what's particularly interesting about Spain's regional market is the supply and demand imbalance. Spain currently has a housing deficit of approximately 500,000 units. In major cities and tourist hotspots, this shortage is even more acute. Only 14% of new construction targets middle-income buyers, exacerbating affordability issues in urban centers. This supply constraint is a fundamental driver of price appreciation that isn't going away anytime soon. Construction costs rose 12% year-over-year, delaying 30% of planned residential projects. Land scarcity is another factor. Only 12,000 buildable plots remain in Madrid, necessitating vertical development. Now let's examine the different investment sectors within Spanish real estate, because each offers unique opportunity profiles. Spanish real estate isn't just about residential properties. Let's break down the key sectors and their performance metrics to understand where the best opportunities lie. First, let's look at the residential sector, which dominates investment, attracting 35% of total capital in 2024. Buy-to-let investors in Spain achieved average gross rental yields of 4 to 6% in 2024, rising 7.3% in prime coastal areas like Marbella and Mallorca. Combined with capital appreciation, total returns reached 10.8%. This is significantly higher than most European markets. What's driving these strong returns? Several factors. Persistent supply shortages estimated at 500,000 units. Strong demand from both locals and international buyers. Rising construction costs limiting new supply, and increasing preference for rentals among younger Spaniards. Within the residential sector, there are interesting subsectors emerging. Student housing, yields of 5.5 to 6.5% in Barcelona and Madrid, driven by 20% annual increase in international enrollments. Universities often lack sufficient accommodation, creating opportunities for private investors. Senior living. Demographic shifts, like 22% of Spain's population will be over 65 by 2025, are spurring demand for assisted living facilities with projected yields of 7 to 8%. This is an underdeveloped sector in Spain compared to other European markets. Next, let's examine the logistics sector, which has been transformed by e-commerce growth. Spain's logistics sector absorbed 1.2 million of square meters of space in 2024, with prime rents reaching 6.5 euros per square meter per month in Madrid. Yields have compressed to 4.2%, but rents are growing by 6% annually due to e-commerce demand. What's particularly interesting about logistics in Spain is that 25% of European firms relocated warehouses to Spain in 2024 to reduce supply chain risks. Urban logistic hubs in Barcelona and Valencia saw rent increases of 8%, and limited land availability is creating scarcity value for well-located facilities. The retail sector tells a more nuanced story. Despite e-commerce growth, brick-and-mortar retail investment surged by 121% in 2024, focusing on experiential venues. Prime shopping streets in Barcelona and Madrid achieved rents of 250 euros per square meter per month, while outlet centers reported 95% occupancy. The key insight here is that while secondary retail locations struggle, prime locations continue to thrive, especially those catering to tourists and luxury consumers. Finally, let's look at the hospitality sector, which benefits directly from Spain's tourism boom. Hotel transactions totaled 4.1 billion in 2024, with luxury resorts trading at 500,000 to 700,000 per room. Hotels achieved RevPAR growth of 5% in 2024, with premium resorts in Ibiza and Costa del Sol trading at capitalization rates below 5%. The hospitality sector is evolving beyond traditional hotels to include extended stay accommodations for digital nomads, branded residences combining hotel services with private ownership, rural boutique hotels catering to experiential travelers. Now let's talk about the barriers and challenges in the Spanish market, because understanding these is crucial for developing a successful investment strategy. While Spain offers tremendous opportunities, investors need to be aware of several challenges and risks. First, regulatory tax and uncertainties create complexity. There is a proposed 100% surcharge on non-EU buyers that could deter foreign investment, particularly in coastal markets. Catalonia's 3% annual rent cap has reduced investors' appetite, with buy-to-let transactions down 18% in Barcelona. Second, climate risks are becoming more significant. About 15% of Mediterranean properties face coastal erosion risk by 2030, lowering valuation in Malaga and Alicante. Water scarcity in Andalusia has halted over 50 golf course developments, affecting adjacent real estate. Third, there are operational challenges. For foreign investors, navigating Spanish bureaucracy can be time-consuming and complex. The language barrier, different legal system, and the regional variations in regulations create significant friction for international buyers. Despite these challenges, the outlook for Spain's real estate market remains strongly positive. CaixaBank research predicts a 5.6 to 5.9% price increase in 2025, with 32% of municipalities exceeding 10% growth. Several long-term trends support continued market strength. Demographic shifts will create new demand patterns. Spain's aging population, 19.5 million Spaniards, will be over 65 by 2030, will drive demand for retirement and healthcare integrated housing. Meanwhile, urbanization continues with 83% of the population residing in cities, intensifying pressure on urban housing. Infrastructure investments are enhancing property values in specific areas. The expansion of high-speed rail networks, airport upgrades, and new metro lines in major cities are creating localized appreciation opportunities around transit hubs. Sustainability is becoming a key value driver. Energy-efficient homes command a 15 to 20% price premium, with 60% of buyers prioritizing green certifications. This trend is expected to accelerate as energy costs rise and regulation tighten. With this comprehensive understanding of Spain's real estate market, let's talk about the practical implications for investors. How can you capitalize on these opportunities, especially if you don't want the complexity of direct property ownership? After analyzing Spain's real estate market extensively, I've identified a unique investment approach that gives you exposure to this booming market without the traditional headaches of property ownership. It's called discounted debt investments, and the INDEMO platform makes this accessible to individual investors like never before. Here's how it works. Spanish banks sell non-performing loans at significant discounts. These loans have borrowers who have failed to make payments, but importantly, they include the real estate asset attached to them as collateral. Second, INDEMO's partner carefully select the most promising of these discounted loans and bundle them into diversified notes, spreading risk across multiple properties and regions. Third, through the INDEMO platform, you can invest in these notes, gaining exposure to Spanish real estate debt at a substantial discount to face value. Fourth, when the underlying properties are sold at the market value, you receive your share of the profits, typically generating returns of 15.1% according to INDEMO's current offerings. The beauty of this approach is that it solves many of the challenges we discussed earlier. No need to navigate Spanish property laws or handle maintenance issues. Built-in diversification across multiple properties. Professional management and execution. Access to bank-quality mortgage loans as a collateral. Exposure to Spain's appreciation without direct ownership. Complexity, and typically provides two-digit returns in just 12 to 18 months. Looking at the INDEMO platform, we can see investment opportunities across Spain's key regions from Barcelona to the Costa del Sol and Canary Islands. My current investments show a 50+% return. For investors looking to capitalize on Spain's real estate boom without the traditional barriers to entry, discounted debt investments through INDEMO represent one of the most efficient approaches I've found. If you are interested in exploring these strategies further, visit INDEMO's website to learn more about how discounted debt investments work and see their current offerings. I've included the link in the description below. Well, Spain's real estate market is experiencing a renaissance that creates opportunities for those who understand the underlying dynamics. Whether you are interested in discounted debt investments or traditional property ownership, the key is to act based on data, not outdated perceptions of this rapidly evolving market. If you found this analysis valuable, hit the subscribe button and notification bell to stay updated on more in-depth market insights, and drop a comment letting me know which region of Spain you find most interesting from an investment perspective. This is Psycho Investor, and I'll see you in the next video. Stay psycho, stay profitable.